Welcome to this explainer. Okay, let's just get right into it. So recently, you probably saw silver dip under 60 bucks an ounce and gold kind of slip down near 4,100. It's been a turbulent and honestly a pretty fascinating time in the markets. If you're an investor, a collector, or honestly just someone trying to make sense of this shifting global economy, you're probably sitting there wondering, what is actually driving all this sudden, dramatic action?
Right? Why is silver swinging so violently right now? You might think, oh, it's because American aircraft recently struck targets in Iran, or, well, oil just jumped 3% before I even finished my morning coffee. And sure, those kinds of headlines absolutely cause a reflex flight to safety. It's just human nature. But to truly grasp the mechanics of this market, we've got to look completely past those geopolitical headlines.
I like to think of this as the iceberg model of the market. Right on the surface, you've got your distractions, overseas strikes, sudden oil price spikes. That surface noise is incredibly loud and it grabs our immediate attention. But right beneath the surface, that's where the deep currents are flowing. Things like the underlying math, jobs data, Federal Reserve actions. These are the powerful structural forces that actually govern long-term prices.
Section 1. Noise versus the signal.
To really see this in action, we need to look at a highly surprising piece of economic data that completely shifted the market's momentum just last week. The number you're looking at, 57,000, is pretty staggering. The U.S. economy added a shockingly low 57,000 jobs in June. Now the forecast, that was calling for around 110,000. So that is a number cut directly in half. It was the absolute weakest print we've seen in 4 months. This massive miss immediately pulled down the value of the dollar, which, as you know, makes silver cheaper for global buyers transacting in yen, euros, or rupees. But why does a jobs report matter so deeply to a piece of physical metal?
Well, to understand silver's reaction, we really have to talk about opportunity cost. Remember, physical silver pays no dividend, it offers no yield. It literally just sits in a vault, or maybe a drawer in your house. So if jobs data is incredibly weak, the odds of a Federal Reserve rate hike drop significantly. And lower interest rates mean the opportunity cost of holding physical silver goes way down, which sends capital drifting away from cash accounts and right back into precious metals.
Which brings us to Section 2, the Federal Reserve's puzzle.
This puzzle gets tricky because while that terrible 57,000 jobs print was released, the overall unemployment rate actually ticked down to 4.2%. Enter the new Fed chair, Kevin Warsh, who recently, shocked Wall Street by holding rates steady while breaking virtually all the communication norms. He released this tiny 130-word statement, outright refused to submit his own dot plot projection for future rates, and instead, he launched 5 new task forces to review how the Fed operates. It was basically a small institutional earthquake. He tore up the standard communications playbook and just declined to hand the market a new one. This leaves analysts totally guessing, which obviously creates massive volatility.
Section 3. Draining the COMEX vaults.
So here is the crucial point. While Washington is playing this monetary theater, there is a completely separate second market operating entirely on physical math, and it lives right inside the COMEX vaults. But before we look at the numbers, understanding this terminology is absolutely vital. Inside these vaults, we have registered and eligible silver. Registered is fully warranted and ready for immediate delivery right now, today. Eligible, on the other hand, meets the identical purity standards, but lacks that formal delivery warrant. When registered stock drops sharply, it is a huge signal. It means real delivery demand is physically pulling metal completely out of the system. And the drop in inventory? It's genuinely staggering. COMEX registered silver has plummeted by roughly 3/4 since 2020. We are talking about a massive drop from over 340 million ounces down to somewhere near 88 million today. That is real, heavy physical metal leaving the system, folks. It's not just a rounding error on a digital spreadsheet, it is a physical reality. Layered right on top of that historically thin 88 million ounce cushion is this massive number, well over 200 million. That's the open interest, basically the outstanding paper promises to buy or sell silver at a future date. When you stack well over 200 million ounces of paper claims on top of just 88 million ounces of registered deliverable metal, you get a coverage ratio that is a major sensitivity signal. The cushion is thinner than it has been in decades, meaning any real rush for physical delivery could create an extreme squeeze.
Moving on to Section 4, the Eastern Silver Premium.
The plot thickens even further when we realize that while New York sleeps, a completely different game is playing out on the other side of the planet, and it's one that Western coverage often misses entirely. Chinese physical silver premiums on the Shanghai exchanges consistently remain higher than London and New York spot prices. Now, in a perfectly efficient world, this gap should close instantly through arbitrage, right? Traders would just buy cheap in the West and sell high in the East. But strict capital controls and complex logistics keep this gap wide open. What this tells us is that Eastern buyers deeply believe in the long-term structural story of silver, and they are totally willing to pay a premium for it, completely ignoring this week's Western headlines.
And why are they paying that premium? Well, because China has an unstoppable industrial appetite. Think about this. China manufactures roughly 4/5 of the world's solar panels, and every single one of those panels requires silver conductive paste to function. Layer on top of that the massive global growth of electric vehicles, sweeping 5G telecom infrastructure, and complex semiconductor fabrication, and you've got a colossal buyer that absolutely needs physical metal to build the future. This demand persists regardless of what the Fed does with interest rates today. They aren't trading paper over there, they are building infrastructure.
Section 5. A structural global deficit.
If we zoom out a bit, we see that a single dramatic week of trading simply doesn't erase years of accumulated arithmetic and severe supply constraints. The physical reality of the silver market is strongly asserting itself. The Silver Institute actually projects a 46 million ounce global deficit for 2026. This marks the 6th consecutive year that demand has outrun supply. To fill this ever-widening gap, the market has pulled over 760 million ounces from above-ground stockpiles since 2021. And those stockpiles? Yeah, they don't just magically refill themselves.
So, you might be wondering, why don't miners just dig up more silver to fix the deficit? Well, roughly 75% of all mined silver is merely a byproduct of extracting other metals. Things like copper, gold, lead, and zinc. Producers can't just flip a switch to chase higher silver prices because silver is often just the bonus that comes along for the ride while they mine something else entirely. Because of this totally inelastic supply, global mine production remains stubbornly flat, even as demand absolutely skyrockets.
Section 6. 55 or 70.
Let's look at the scenarios impartially to understand exactly where silver could be heading next. Based purely on this arithmetic, we really have to look at both sides honestly here. On the bearish side, a hawkish read from the Fed and hot jobs data could easily see silver retest $55 as the dollar strengthens and that opportunity cost problem returns to the foreground. But on the bullish side, dovish economic data paired with those undeniable structural COMEX drains and those high Eastern premiums we talked about, that could easily push us back to $63 or even all the way up to $70 an ounce.
And this really brings us to the ultimate takeaway from this explainer. A market can be moved by a headline for an afternoon, but it is eventually governed by its arithmetic. That is absolutely crucial to remember. No matter what headlines hit today, whether it's an overseas strike, an oil price spike, or a brand new Fed task force, the underlying physical math of a 6-year structural deficit in the silver market remains completely constant.
So, I want to leave you with this question. Where do you think this lands? 55 or 70? Are you betting your portfolio on the short-term Washington theater and surface noise, or the long-term vault arithmetic? It's a massive, fascinating puzzle, and I hope this explainer helped you see those deep currents moving beneath the surface. Keep learning,